Hey guys, I just wanted to reach out to you and let you know that Surewinder is still selling amazing products. Some of you guys have been dragging your feet for whatever reason. If your shoulder hurts, do not waste time. Pull the trigger. I just bought 4 or 5 of them, and we had 2 guys out. You know how much it cost me to pay for 2 guys being out with bad shoulders? We just pulled the trigger and we said, listen, everybody's going to have one on a truck. It's mandatory. You got to use it. Don't hesitate. Don't wait till your guys go down. It's going to cost you more. Buy a Surewinder.
What's up, fellow door peeps? Ryan's in the house. Let's get the sound going good. Check, check. Let's go. All right. Today, we're going to continue what we started. This will be good, I think, for small to medium-sized businesses. But we're going to work on some financial stuff. And I know this might be a little tough to get through, especially if you're listening to it like you normally listen to it. If you're in the truck on the way to a job, if you're in a garage trying to listen to it, this one may be tough. This may be one of those podcasts where you set aside a little bit of time and you just take notes. And I want to preface by saying I am not an expert at these things. I know enough to get in trouble and maybe a little more in some areas, but I'm talking about a topic that I am definitely not an expert in, which I wouldn't consider myself an expert at anything, just because I think that's weird. But I want you guys to know for sure, I am definitely 100% not a financial advisor. I have learned a lot of this stuff that I'm going to be sharing with you through trial and error and learning from other people. I'm going to point you in some directions, hopefully, that will give you enough information that'll save you an awful lot of heartache. And I think that's what's important. And I hope if you get anything from this podcast, it's going to be take action, slow down long enough to set these things up, put them in place, put a structure and system in place for them, and then take them very seriously. Because I can't begin to tell you, I talk to a lot of business owners. So let's just jump right in. Before we get started, I do have some announcements. We are live with super early bird pricing on Garage Door Summit, garagedoorsummit.com. Go check that out. We have standard and all in. I'm about to record videos to put on those pages, so there'll be video explanations of those so you can have a deeper dive on that. But I'm giving you the absolute best pricing for non-GDU members. If you are a Mark Annuity client and you want to go and you're not part of GDU, hit me up. I can give you a little bit of a deal. If you are not neither, you're welcome to come. Like, this is one of the most, I tell you, I was a little disappointed with the Vegas show just because I wasn't happy with everything. It wasn't my best show. I'll tell you that. It was probably one of my worst shows. But what I will tell you is that will never happen again. I'm going all freaking out on this. We're pulling out all the stops. We're going to Puerto Rico. We're staying at a high-end luxury resort. I mean, we are going all out. We got Willie Robertson from Duck Dynasty coming. We already have 4 sponsors committed and paying for their sponsorship. We have 21 people already signed up. We only have a total of 55 seats. So we haven't even opened it to the public. Like, it just opened this week. So I'm telling you, I have never had it easier when trying to promote an event or when trying to get people to sign up or to get sponsors. This has been the easiest event, and we haven't even launched it public yet, and we're already almost halfway sold out. please, 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 please hear me. And you're going to make it so much easier for me. If we just sell these out as quickly as possible, we can focus on making the event better. And so if I can get a bunch of people to sign up, I can shift my focus from trying to get people to sign up to trying to make the event better. So help me out with that if you don't mind. Would greatly appreciate it. GarageDoorSummit.com. GarageDoorSummit.com. Check that out. All right. Enough about that. More details on that coming, but just wanted to let you know you can go there, check out all the information. We got sales training that we'll be doing. I leave tomorrow. So while you're listening to this, I will be in training in Knoxville for a dealer out there. And he's got about 7 people, I think he said, in his group that we will be training, and super blessed and honored to have the ability to be able to do that, and super excited about the results that's going to come out of that. He's got some low averages and he wants to try to boost those up. And so we're going to work with him on that. So while you're listening to this, I'll be doing that. But I will be riding back either Tuesday night or Wednesday night, which would be tonight or tomorrow night while you're listening to this, and rocking and rolling, getting back to run the show. Aaron Overhead Doors, like give you guys an update. Last year we just had a horrible year. It was awful. It was a mixture of a couple of things, like really inconsistent sales, number one. 2 was me not moving fast enough because I was out so much, building a house, health issues, like all kinds of stuff. And I wasn't moving fast enough. I didn't have my thumb on the pulse. Like it was just not very good. And I started getting all that stuff together when we got moved in the house. And I don't know. I felt like it was tough. This year, totally different story. We're not killing it. We're murdering it. Having a fantastic year. We just had our best overall month, complete with revenue and also sales combined, we've ever had. And we're up 40% over last year, and just super, super excited. And we've got the best team we've ever had. I mean, most of these people have come in from outside the industry, been trained. This is their 2nd or 3rd year. And we are reaping the benefits of hiring great people with not bad habits and firing people quickly when they come in here with bad attitudes and bad habits. So we're closing June out, and I gotta brag. Like, can I just brag real quick on something? Like, this isn't me bragging on myself. This is me bragging on my people, because I just want to share something real quick. Like, I got a couple salespeople that just absolutely crushed it. My boy sold doors, selling doors, $260,000 in sales. We are, by the way, we are not selling track builders. This is not like a lot of builder work. This is we do a lot of work for renovation, and a little bit, like a very little bit of super high end home builders. But listen to this: $260,000 in sales, $17,462 average new door jobs. That's nuts. Bunch of full view glass doors, bunch of wood doors, just absolutely nuts. And our screen salesman, motorized screens, absolutely nuts. $249,000. One person, screens, motorized screens. Average sale, $19,000. $19,000. Average sale, motorized screens. Holy stinking cow. Crushing it. That is not the rest of the team, which they deserve shout outs. Great job to everyone. But those numbers are insane to me. Talking $500,000 in average sale of like 18 and some change. Nuts. Absolutely freaking nuts. Now, if you guys recall, like back in 2019, we shifted our focus to go super high end. Like we're trying to focus on like high end. So we don't sell a lot of jobs. Like that's not a lot of jobs that we sold. I mean, you could like if you do the math, right? I mean, if you're 250,000, you're 250,000, divide that by let's call it 18,000. I messed something up. Sorry. 18,000 divided by 250,000. 13, 14 jobs, 14 jobs per guy, roughly. It's not a lot of jobs, but they're almost all multi-day jobs and big jobs. So let's jump in. Let's go. I'm ready to rock and roll. So let's talk about some of the biggest mistakes that you could possibly make when starting your business. Not understanding the things that we're going to cover would be a massive mistake. Ginormous. And it's probably one of the most intimidating because most of us going into startup stage don't know how to manage this, don't understand it fully. But I'm begging you, please take the time to get to know this stuff. We're going to talk about financials, setting it up, watching it, knowing what to look for. And if you do these things early, and I'm sure I'm going to miss some stuff. And if I say something wrong, which I hope I don't, like I bounce some of this stuff off people, and I've got some what I believe to be good information here, but I'm no expert at this, but I have the platform, so I'm going to use it because I'm begging you to please, please, please take this serious. All right, number one, I want you to set up a purchase order system. First of all, in order to do that, you're going to need a some type of software. I suggest a bunch of different types of software. You've probably heard me in the past. For startups, I love Jobber. Love Jobber. Looking for an inexpensive product that works really well, that can scale up with you to the million, multi-million range. And by that time, they may have developed their product to scale further. But what an incredible software, an incredible team and support. Love them for startups. So, a purchase order system. What is it? And some of you guys may already know this, so please don't shut off yet. We're getting into some of the deeper stuff here in just a second. But a PO system is an identifier that your company put on a purchase to track it from beginning to end. So, for example, when I started Aaron Overhead Doors, I went to go make my first purchase, and I knew of purchase orders, like I knew of those. But when I went there, they were like, "Okay, what's your PO?" And I'm like, I don't know. So I quickly racked my brain of like, what would be something so unique that probably could never happen again, but also could be easy identifier for me so that if I called, I wouldn't have to look it up. So what I did was we used the last name and the address number of the homeowner. So last name, address number. So for example, for me, it would be Lucia 321. All right. So that would be my PO. Maybe it's Smith 123, and that would be their PO. And so the chances of having someone with the same last name and also the same mailbox number combined would be very small. So that's what I ran with. Now, it doesn't allow for probably automatic generation without some type of automation built into the system. However, it's a great system because when you're on the go and you don't have a full office staff and you're trying to order stuff, that's really easy. Now, what we would do is if you were ordering things from multiple vendors, so let's say you were ordering a door package from the Amar distribution center and they didn't have the motor, and so you ordered the motor from Clopay, we would do something like Lucia 321.1 for the motor. And the original was just Lucia 321. So just some type of identifier. And why that's important, like it's important because I'm going to ask you to keep job costing And I think it's really important to track all the things that hit that job so that you can add that material cost in. Okay. Let's see here. So we talked about explanation of a PO system. We talked about implementing it into your CRM. We talked about the benefits of having that system. It's tracking expenses, managing your suppliers, and job costing, right? So you guys do the research. I'm not going to give you every single detail of all this. I'm going to hit on some of the basics. That's number one. I'm going to move to number two because I think you guys have a good understanding of that and you can do your research. Number two, how to read a profit and loss statement. So I'm going to spend a little bit of time here because I think this is important and it may get a little boring, but bear with me. And if I leave something out, hit me up. I would love to hear other people's perspective. Um, but a profit loss statement is really broken into sections. Okay. And it's really easy to digest and look at. It's probably my favorite report when trying to control expenses. Number one, it's going to show you your revenue. That's going to be at the top. Cost of goods is going to be at the top. That's cost of goods sold. Gross profit, it's a little bit at the top, but a little bit further down. Operating expenses is going to be, the remaining, probably most of it. Then you got like a little bottom section of about 20%. It's going to show you all your nets. Okay. The top section is cost of goods sold. To define that, if you're just getting started and you're unfamiliar, it is literally revenue minus what it costs you to do the job, material, labor, and any expenses, equipment, anything. Like some people say, well, a truck is used to do the job. So we're going to include a truck in our COGS. COGS is just short for cost of goods sold. Some people leave the trucks out and just keep it as a operating expense, right? Some people put fuel in because fuel's needed in order to get to the job. And so maybe you want to do that. Setting up your P&L, I would say, is super important. And you need to figure out how you want it structured. Okay. I would talk to there's different business people, right? You have bookkeepers who really just do what they're told. So if you don't know what to tell them to do, they're not going to know, most likely. You have accountants, right? They're a little bit better. They're going to be able to tell you what you need to do, right? They have accounting degrees where a bookkeeper really just does a certification process. And accounting goes to school, gets an accounting degree. You have a CPA who files taxes. They're looking at your financials very differently than you are, right? And an accountant and a CPA, when preparing taxes, they're going to add in deductions and depreciation, all kinds of stuff. They're going to screw up your reports. You're really not going to have a true analysis of your reports when they add in depreciation. But if they do it right, a lot of times, from what I understand, when I see it, I can just take that out or subtract it or whatever. So make sure you're dealing with the right people to get your financials right, but make sure you get it set up properly. Okay. So if you're just starting out or you're about to start out, this could be the key to your success long term, is setting up a really good foundation on your P&L. I can't stress this enough. Invest the money to get someone to help you get this set up properly, who knows and understands home services or the construction industry. I think those are very important. All right, let's talk about analyzing P&L. Common mistakes when reviewing a P&L. Not reviewing the line items, just scrolling down to the bottom, or looking at gross profit and net profit, and that's all you look at. That's a common thing that I see, and I think that's bad. You need to focus on every line item. Matter of fact, what I would do is every month block off 2 or 3 hours every month after the books are closed, minimum. Wait till the books are closed, get the report, spend a minimum of 2 or 3 hours, like an early morning, probably when your brain is fresh and you are sharp. Go line by line on your P&L and review the expenses. Now, I'm going to tell you, let me see. I think I've got this in my notes. Yeah, I do. So we'll get to that later. All right. Review all the line items. Also, pay attention to seasonality. Okay. This is going to help you do that. So as you get into your business and you get some historical data, you're going to pull your P&L and you're going to compare months and seasons to each other. Q1 to last Q1, Q2 to next, last Q2, first 6 months compared to last 6 months, next month to the same month last year. I mean, there's so many comparisons. I even like going back and comparing, it's June 30th right now. I'm recording this. I like to go back and look at the last 3 Julys so I can get a true expectation of what we're looking at. And then that helps me understand what moves I need to make in marketing, what my expectations are of revenue, all that. So don't ignore seasonality when looking at these reports. If you have a down month, you may have that same down month every year. And what I will tell you is I see a lot of people just throw a ton of money at their down month only to lose a massive amount of money in those months. I don't have the formula. I don't have all the answers. I cannot tell you what the answer is for you and your business. But what I can tell you is that I don't think in months historically when people are on vacation, spending more money on marketing is the best option. What I think the best option is being more intentional and understanding the mindset of the people going on vacation, how they're spending a lot of money that month to go on vacation, right? These people have been saving up probably for a while. They're coming back, tapped out a little bit. They got school starting in a month or two. There's a lot going on. Have that mindset, understand what they're going through, and then create a marketing strategy or plan that might be less expensive, but more effective. I like branding during those months. You can do some really good branding campaigns during those months and get in front of those people 10 times a day if you wanted to. Some really cool stuff you can do with that. All right. Next, don't overlook your recurring items. So let's talk, for example, your non-recurring items. If you have, let's say you paid something in full for a year and it cost you 10 grand and you did that in April. Well, you need to make note that that's coming again this coming April, the next April, right? So don't overlook the non-recurring items that might be coming up that you need to pay attention to. Those expenses or, profit, income. So those are some common mistakes that I see or that people have told me they see. All right, most valuable takeaways when I'm in these conversations is profitability. Understand the overall profitability and margins of the business. Listen, this is why it's so important. Right here is why it's so important, where you need to understand the difference between markup and profitability margin. They're not the same. markup will hurt your business unless you have a way of like a chart where you can see how to convert margin into markup, or this markup equals this margin. But I don't know why you're trying so hard. Why not just take your expenses and divide it by the opposite? So let's say, for example, you wanted 40% gross profit, which should be low. 40% gross profit on the job. You're going to do your total cost expenses for the job, labor and material, and you're going to divide that by 0.60. That's going to give you the sales price with 40% gross profit margin built in. If you want 50, you divide it by 0.50. If you want 60% gross profit, you divide it by 0.40. Okay. This is how we get gross profit margin. I think it's super important that we are managing our expectations with profit. We got to be calculating it right first. Then, once we calculate that right, we need to understand what to look for when profitability on our statement. Number one, you're going to have gross profit margin on all of your COGS, your gross profit margin. I would shoot for high as possible, 50%, 60% gross profit margins. That would be amazing. And I think that's where a lot of door companies struggle, probably even including me in some cases. For whatever reason, I think we sell it one way and then we think we're making X amount, but then we get in these multi-day projects over and over and over again, and we just start throwing stuff in and doing this, trying to make our hero happy. And quite frankly, it eats into our profit margin. Those things drive our profit margins down. So we need to keep an eye on our overall profit margin. And I think that's really important. So we would like to have these on the low end, probably 45%. On the high end, as high as possible, but let's shoot for 50, 60%. I think that would be wonderful. And if you can get those numbers, that'd be great. That's pricing your services out properly and considering your volume as well. So make sure that when you're new, you're not underpricing the market. And then when you start hiring people, they get used to selling services and products so cheap that when you start accruing expenses, you have to retrain them to sell products and services at higher margins. It's not good. So number 2 on most valuable takeaways, identifying areas where expenses can be reduced. P&L is great for this because you can actually change the report so you can see a setting that shows you like a year over year or month over month increase percentage wise line item, which is great because then you can see how you're trending with certain expenses. If you have certain expenses that are way out of whack, that's a problem. So we've got to identify that and make adjustments. Revenue trends. Analyzing sales performance over time is also very great. That is the most valuable takeaway. All right, number 3, setting to change for better view. So we had common mistakes when reviewing. We had most valuable takeaways. Now we got settings to change for a better view of your P&L. Comparative periods. We just talked about this. Viewing P&L statement over different periods, monthly, quarterly, yearly for trends and analysis. Trend analysis. Look, you can print these out or you can do a view of month to month out like the last 3 or 6 months. I love to look at the monthly view spread out over 3 to 6 months. I love to look at quarter comparison over previous quarter, quarter comparison over last year's same quarter. I love to look at annual year to date versus last year to date. I mean, let the data tell the story and then you figure out what changes need to be made. But you're only going to be able to figure those things out and see the full story if you're viewing the data from a 360-degree view. Pull those reports, look at them carefully, go through them, spend time, invest the effort that it takes to do that and get your numbers really well. Number two of settings to change is departmental reports. So you can segment out your P&L by department or product line to pinpoint profitability areas. So for example, you're going to want to do this for like maybe repair. You're going to want to do this for door sales. You got commercial service versus door install, like whatever. You want to break those out because here's the thing. If you invest in a new department or you invest in a new showroom, you want to break it out. You need to see if that is profitable or not. If it's not profitable, then what are you doing? Right? You give it time if it's new to get profitable, but you need to be tracking in the right direction. So getting those things set up, that's going to be good for you if you're just getting started, is segmenting your P&L so you can see where your money's coming in. Are you getting more profit on service? Are you getting more profit on door sales? You got to figure all that out.
Hey guys, I found something that changed my business and I want to share it with you. We've created packages that have included some of the best products in our industry to offer our service customers. The heart of that package is Stealth Hardware Kit. Stealth Hardware is the quietest hinges on the market. I challenge you to buy at least one of these, test it for yourself. Put it on your truck and design a quiet performance package for your customers willing to pay for a better, smoother running door. Buy your Stealth Hardware Kit at Service Spring, do a search for quiet hinge, and then buy that. You can buy a double or single door, 7 or 8 foot tall, and promise you, it'll change your service forever.
Somer USA and Somer Group want to thank you for an incredible year and the trust you've put in them and their products. As you know, Somer places high value on relationships, education, customer service, innovation, and professionalism. And they are grateful to you for your part in the fostering and dissemination of these values. If there is any way Somer can support you in your journey, whether through their products, the values they hold to, or the knowledge Somer has gained through interaction with door dealers across the world, please reach out to the team at your convenience. They are here to serve you. Again, thank you from the entire Somer team. Check them out at somerusa.com. Tell them Ryan sent you.
All right. Exclusion of non-operational items. So adjusting for non-recurring items to get clear view of operational experience or performance. Sorry. We talked a little bit about this before, but you can exclude non-operational items. Adjusting for non-recurring items to get a clear view of operational performance. That was a little deep. Not sure. All right, number 4, comparisons to show progress. So we got common mistakes, most valuable, settings, and now we got comparisons to show. We talked about this already, but I'm just going to hit them because I got them on my notes. Month to month, compare monthly results to track short-term performance quarterly. And I also thought this was great. I'm a big fan of this. Huge fan. Huge peer comparison, benchmarking. If you can get into any type of benchmarking of financials, that is great. We try to do that in GDU, and we had a little bit of trouble getting people's financials, which is understandable. But I would love to get that set up and get more participants so that when you pull your P&L, you can log in and see how you compare to everybody else. Beautiful. All right, so we have covered purchase orders, how to read profit and loss. We're going to hit on the balance sheet. Assets, liabilities, and equity. Okay. This is pretty straightforward, but you got to make sure that you log all this stuff. You got to figure out what's an asset in your business, what's a liability in your business, and then what's the equity that it has. And so tracking all that, I think, is very important. And let's see here. You're going to want to know current ratio, debt to equity ratio. I know you guys are probably struggling. This is boring stuff. But if you are starting your business and you do these things, I promise you it's going to make a huge, huge difference in your business. All right, cash flow statement. What did we just talk about? That was balance sheet. Let me bounce the balance. Bounce to balance. That was funny. Okay, here we go. I got some notes. Let me see. Give me just a second. I apologize. I thought I was fully prepared for you guys today. There's like, honestly, I'm just going to say this on the balance sheet. It's pretty straightforward. It's not a lot. Just make sure you enter all that in and you just look at it every month so you can figure out where your ratios are, right? Um, you want your business to be as profitable as possible. And if you take out a loan, it's going to flip that. And you need to have all of your liabilities and assets on your balance sheet. So if you buy a building and you paid cash, that's an asset, right? If you financed it, you're going to have the building and the loan is the liability. So all that'll be listed on there. And I think it's very important. And then you're going to take the difference of the two, and that's how you get your equity at the end. All right, let's talk about cash flow. Oh my goodness. I don't even know. Um, Cash flow is one of the most difficult things to manage along with profit, net profit in a garage door business. So when we're dealing with this, bear with me. I am not an expert at cash flow statement. I'm trying to learn. So I'm going to be sharing my notes from what I know and then what I got from other people. So common mistakes when reviewing a cash flow statement: ignoring timing differences. Not considering the timing of cash inflows and outflows can lead to misinterpretations. That's number one. Confusing cash flow with profit. Assuming a positive cash flow means profitability, which isn't always the case. Oh, I'll also go back. I did have one thing I wanted to add to. Okay, if you were reviewing last month's P&L and you closed it out and it said you had a profit of $10,000 and you only have $3,000 in the bank, that report is not going to show you your cash in bank. Okay. So we're going to talk about a little bit about accrual on profit and loss versus cash flow, or cash basis versus accrual. So I'm going to go back to that, but I think it's really important. So, all right. I think we hit on it, but I want to dig a little bit more into it. So common mistakes are not reviewing line items, ignoring seasonality. Oh, that was probably lost. I'm sorry, y'all. Common mistakes: ignoring timing differences, confusing cash flow with profit, and overlooking non-operational cash flows. Those are the three common mistakes when reviewing your cash flow statement. All right. The big number two, most valuable takeaways for the cash flow statement: operational health, understanding how well the business generates cash from its core operations; liquidity position, assessing the ability to cover short-term liabilities; investment capacity, evaluating the funds available for reinvestment or expansion. All right. So you want to get a new showroom. You want to buy someone out. You want to buy a new truck. Any of those things. This report should be able to tell you how you look on that. Number three. This is the big number three. So we covered common mistakes, most valuable. Now we're talking about settings, period adjustments, reviewing cash flow on a monthly, quarterly, and annual basis to identify trends. And then category breakdown, detailed categorization of operational investing and finance cash flows for clarity. That's just getting like deep into it, right? We talked about categorizing earlier on our P&L. Big number 4, comparisons to show progress, year over year comparison, budget versus actual. So you're comparing actual cash flows against budgeted projections. Please take time to do that. That has been a struggle of mine. I'm not going to lie to you. It's tough, but I promise you, if you do it, it's going to be so good. Do a budget, and then see how you go up against that budget after that month closes out. And if it's not in the budget, try not to spend it. Push it off, put it in the next month. Check your cash flow statement. See if you're going to be able to afford it next month. Maybe you want to buy a truck, right? And it's $10,000, but the football team that you sponsored last year is coming up for renewal this year, and it's next month, and it's $10,000. And you want to sponsor that football team because it brought you a lot of money, or a home show that you got to pay for. You look at your cash flow statement, go back and do your year over year comparisons for next month. A big expense or something you want to buy is coming up. You look at it and you say, oh, wait, I can't buy this truck right now because I need this cash for renewing my home show or sponsoring the school, right? So these are all great things that I think are super important to be watching. Goodness, there's so much stuff, y'all. But I'm trying to stay high overview so I don't lose you, or myself for that matter. Good Lord. All right. So we are going, we just talked about cash flow. We talked about balance sheet. We're going to talk about other reports and KPIs to watch for. Budget versus actual. We just talked about that. We need to have that. We need a sales report. Sales report should have some KPIs on it that we need to measure. Number 1, how many opportunities we got? How many did we close? What's our average close ratio? You're going to get that from those 2 numbers. What's our average close dollars? Our cost of acquisition for that sale or that customer, right? Those are great KPIs to be able to chase. Key performance indicators for financial health are gross profit margin, net profit margin, inventory turnover. So I just want to stop right here real quick. If you are doing a PO system, you might as well do inventory and have an inventory system that can show you how many things of each item that you're selling on average per month. And then you can set your minimums, and then you can have it. Some inventory systems will reorder the parts for you once you hit that minimum. And so figure out what your lead times are on these things, which can be done now. And you can get alerts when you hit your minimums. Nothing worse as a small business and go and selling something you don't have it. Right? So in order to help yourself with this, slow down a little bit and make sure that you have some type of inventory system in place with minimums that will tell you when you need to order something. And here's another thing. It's not important to me that you buy springs $8 a piece cheaper at this point, right? It is way more important as a startup that you have cash on hand. You're able to pay your bills. You invest in people and things like that, growing, marketing, whatever, more than it is having 3 months worth of springs on the floor because you were able to save $8 a spring. Don't do that. Don't do that. That $8 isn't enough. Just buy the springs at the price that's easy, comfortable for you, and then pass that expense on to your clients. Let them pay it, right? You're a new guy. You shouldn't be paying these expenses. Use your money wisely. Do not buy in bulk too early. Inventory turnover is going to help you because it's going to tell you how quickly you're going through certain things. Accounts receivable. How long does it take you to get paid? How many days after you do the job? This is super, super, super important. If you're in residential only, just collect on site, make it a standard, and very day one, do not invoice people ever. This is the job. You pay it. You don't leave until you get paid. Its job's not over until you get paid. Don't leave. Just set the standard that everybody's going to get paid, or you're going to get paid when you finish your jobs. When you hire people, that needs to be a number one rule. You do not leave a job unless you're paid. Period. If people need to leave, you get payment before they leave, even if you're not done with the job yet. Because people will try to leave in the middle and they won't pay you, and then they won't call you back, and you're literally in their house, but they won't call you back. It won't come home, won't get payment. I've had it happen. So just get payment upfront. Do not invoice. If you invoice, you're going to be chasing money. You don't have the resources to do that. Plus, you need cash flow. You need cash flow. So every dollar counts. Get that money in house as quickly as humanly possible. All right. Number 7. This is a big, big number 7. We're going to talk about the difference between accrual and cash basis accounting. Man, I am so sorry. This is probably boring the snot out of you, but I can't begin to tell you how important this is. Explanation of accrual is this: recognizing revenue and expenses when they are incurred. Example, let's say that you order a door, okay? And you're on net 30 terms. All right. You're going to put that bill in with a due date of 30 days from now. That expense is going to hit, because it's June 30th right now, it's going to hit in July. So we're going to count that expense in July. But we have the bill and we know it's coming. The opposite of that is cash basis. We go to the DC, we buy the door, we pay them in full for it, and we leave with it. That would show cash in, cash out. Okay? We're going to recognize that June 30th. And we're going to look at cash basis. Is simple. It's easy. I do like cash basis. Don't get me wrong. I do like cash basis. It's easy to look at. But you are looking at previous data, historical data. Cash basis is what came in and what came out. Accrual gives you an insight as to what's coming up due and what cash is coming in. Okay. I can tell you that most of my stress in the early days was when we got to the point where I couldn't categorize everything in my brain anymore and keep track of all the financials and bills due and all that. And we were selling so many doors that I couldn't keep track of like when the doors were due, and it was just a mess, right? When it gets like that and you're just looking at one big bucket of money coming in and out, there were so many things that stressed me out because I didn't know where the money was coming from. I didn't know how much was going out. And especially when you let go of some of the finances and you trust your team to pay the bills and this and that, you're going to want a system in place that, one, checks those bills to make sure that they're legit, because there are businesses like legit. There are people out there that send invoices to businesses and they'll just pay them. They'll just pay them. Right. You got like, there's some that target garage door companies, and I've had people pay them before. And it's disgusting, like seriously disgusting. It's a total scam. And they'll send you an invoice for like $400 and your staff just pays it because that's what they do. You need a good system in place where that doesn't happen. Maybe you need to approve all the upcoming bills, or any bills that come in that aren't recurring, that are one time, need to be approved by you. Okay. So we're talking about cash basis and accrual basis and the difference between the two. If you are set up for accrual, you can still check cash basis, right? but you've got to make sure you're entering in all your bills and your expenses for accrual. Otherwise, you won't be able to see your projections. Your cash flow is a big part of that. All right, so let's see here. That's going to be tough. It's going to be tough for a startup. But if you can get started on accrual and get that mindset, man, I tell you what, it's going to be huge. All right, let's see here. What else? I'm going to hit on two more things real quick. I got a minute. All right. I'm going to hit on these. This was a big topic in GDU earlier this week where we were talking about loans. Okay. If you're a startup business, should I take a loan out? To me, the answer is depends. It depends on how disciplined you are and what you're going to use the money for. Okay. So I'll start with this. I'm a big fan of lines of credit. Lines of credit are great because you'll probably have a small fee up front, a processing fee and an application fee. Spend $300, $400, $500 maybe. If you bank with somebody who's really good, maybe they waive all those. I don't know. But then they're going to give you a line of credit. And this line of credit has no interest on it. It may have a term where you got to renew it every year, 2 or 3. But the goal is to not use it or to use it in the case of an emergency. Okay. As a startup, you probably don't have an emergency fund. And quite frankly, you really don't want one. I mean, I know that sounds horrible, but I'm using money. If I have a bunch of cash sitting on the side for an emergency fund, that means I'm not using that money to grow my business and to get better. So I like a line of credit for that. Is that a gamble? Is that a risk? Yes. So is starting a business. And you're going to take many gambles and risk along the way. So I like lines of credit. All right. I like loans in the beginning for trucks. I know there's a big debate where people disagree with me on this. I don't want my trucks breaking down. I just don't. A truck being down for 2 weeks while it's in the shop, waiting on a part, getting fixed, coming out. I'm not even worried about the expense of fixing it. I'm thinking about how much money is it costing me of not being out doing jobs. You're talking about tanking cash flow, hurting your business, shooing away customers because you can't get to them. Like, you need a reliable ride. And I would try to make it look good. And so you don't need like a F-250 service body. That's what we run in now, but you don't need that. Like, what's the minimum that you need to be able to stock your truck with a day or two's worth of parts, manage all your tools, secure everything, have some operators? That's it. That's it. And I would honestly, I would take a loan out. I would not buy that truck cash because I would use the cash somewhere else. If you're going to have that truck going out doing sales and service and door installs, you're a one-man show, or even 2 or 3 people, like if you're, let's just say you're paying a $750 note a month. Like, I am not sweating that right now if I'm out hustling, right? I'm not. It's just not important to me. So I like lines of credit. I'm okay with loans on vehicles, especially rather than spending my cash on it. Cash is valuable. So in the beginning, I'm going to keep that cash in the bank and use it to grow instead of paying off trucks and things like that. Now, there's difference of opinions out there. There's some people say if you start your business with no debt, you don't have much to worry about when the economy turns down. Yes, that is probably very true. The economy, I've been through multiple economy issues, and I can tell you that there are times where it gets really tight and it's tough, especially if you have debt, if you got a lot of overhead. And so you got to manage that properly, right? And make sure that you are balancing all that. Sounds like somebody's coming through the walls. All right. The good, the bad, and the ugly of using loans. Pros of using loans are capital for growth, managing cash flow. If you can't make, let's say, for example, like I just did a big job for the Atlanta Falcons, we had to pay over $100,000 in material. We had to pay a massive amount of money for labor. Well, we took a deposit, but we were still owed a massive amount of money. And so I'm a bank right now, right? They're essentially on a loan because we're on payment terms with them. So till I get paid, I got to front all that money to our vendors and our team. And so cash flow is great. Now, I'm blessed. We did not have to use any type of line of credit. We had some money set aside for this, but that's a big chunk. That's a big chunk. But if you have a line of credit and you don't have that money set aside, then you can dip into your line of credit, maybe pay a small portion of interest while you're waiting on that check, make your payroll with no problem. And as soon as you're able, you start paying that down and get it down as quickly as possible. That should be a mission every time you charge on it, right? So some of the cons of it are this money's going to cost you interest. And then there's going to be occasions where the bank's going to call the loan. Listen, I'm telling you, I've been around enough to know that when the economy becomes crap and these small regional banks get hit hard, they recall loans and they want all their cash. So don't get in over your head, because if they do recall the loan, you're screwed if you don't have the money to pay them, or another bank's not willing to refinance it for you. I've had it happen. So be aware that that's a reality. You don't just go take a loan with the idea that you've got X amount of time to pay it off. You do, but if that bank's looking at closing their doors versus collecting from you, they're collecting. Believe that. And it's in the contract. You're most likely signing a contract that states that they can call the loan when they need it, if they need it. All right. What are we going to use a loan for? We talked a little bit about a few things. I'm going to use a loan for efficiencies. I'm going to use a loan for growth. What do I mean by growth? What I'm not going to use a loan for is just to grow my top end number, my revenue, without it impacting positively my bottom line number. Right? So be prepared and know that when you're investing money in your business with loan money, that payment's going to come due. And you need to be able to increase your revenue and net profit greater, I would say 2 times greater than whatever the payment's going to be. So let's say, for example, the loan payment is going to be $1,000 a month. You need to be able to increase your net profit by a minimum of $2,000. That way you have $1,000 of profit you can put away, or you invest it back in your business, and $1,000 of the profit to pay the loan. Or even alternatively, you could take all $2,000 and pay it off in more than half the time, or less than half the time. All right. What you don't want to do is you don't want to use this loan for pretty much anything else. Like you got to be really careful. If you use this money for stupid stuff, it's you play stupid games, you get stupid prizes, and there's no faster way to get a stupid prize than take out a loan and use it for stupid stuff. So equipment purchases, expansion, working capital. I like loans for those things. I do not like loans for covering operational losses. And I think that that's what a lot of people use them for. All right. I know today was different, very tough. I'm passionate about you guys, startups, trying to help you not go through the same pain that I went through. And I hope today was helpful. If you guys don't mind, will you just reach out to me and let me know if this is the type of content that you're okay with? I don't know if this is what you guys are cool with or not. So please let me know if this is not cool. Like you're like, man, this sucks. Like I want to hear something completely different. You know, my vision for this podcast is and always has been to educate and entertain. I want to educate and entertain. That's it, man. I just want to have a good time on here and I want to help people. I want to educate and entertain. And I probably don't do as much entertaining as I would like. That's why you gotta come to the summit. Yeah. See how I did that? So if this is way off basis or you're like, man, I can only listen in the truck and this is crazy, I can't listen to this in the truck, please hit me up and just let me know so I got a good idea of if this was helpful or not. That's all I'm looking for. Hope you guys have a wonderful day. Be blessed. Thank you for your support of the podcast and everything that you do out there. Keep hustling, grinding. I think the next podcast I'm going to go through is going to be on leadership. How to hire your first people, how to treat your first people, that onboarding. And then we're going to break down more leadership. I'm really, really, really in the vein of leadership. And I feel kind of led to just spend a lot of time there in a lot of different areas of my life. So I'm going to be focused on that a lot. Leadership is so important. And I think it's a missing component. A lot of these guys starting their own businesses, maybe this is you, have sat under many bad leaders and you're about to go duplicate some of those same things. And I'm going to tell you, it's going to get you in the same place. Okay. So we're going to talk about leadership over the next few weeks. I might come up with some different ideas. If you're wanting to start up your business and you've got some things that you would like answered, hit me up. I'd love to chat with you. And maybe I'll throw in some of those on the podcast. All right, guys. Wish you well. Be blessed. Have a good day. See you in Puerto Rico.